Good morning. So, I left you with a ton of review material. Where would you like to start? I need to know so I can upload the documents. So, who wants to start? Should I just go in order? In order means with the numbers. I numbered all the pages in this section, so we could go with that. Let's see. So let's say 3.3. Review 1. Okay, since Brenda asked, I will go for review 1. Review 1 is, or first review you mean? First review is 3.4. Solutions are 3.5. Is that right? I'm talking about the valuation. It's taking time to load. Not sure why. Do this again. 3.5, right? Oh. This one? $4.3. You guys are giving me different codes. I'm not sure. 4.3. Oh, 4.3. Right. Also, you guys want the capital budgeting already. Very good. Let's see. Capital budgeting 4.3. Morning. I did call it review 1. Okay. Okay. Okay, so I'll do capital budgeting. So the test that's going to happen on Saturday, what I'm going to do is I will distribute several different capital budgeting exercises. So you're going to have to work with the one you have. I'll also have questions for the techniques of evaluation. Again, I encourage you to work independently. You can compare answers, but don't share questions. I don't like that. You really need to learn this material. You're going to be professionals, and I have to stress ethics are very important. We have a unit that I'm putting together for the course for you to read through, and you don't think the simplest things accumulate, and it's really important to be honorable even when no one's looking. Okay, so that's going to be my approach for the test on Saturday. Okay, so you want me to do this one, number one? Number one. Question one. That's only one. There's only one on this one. Okay. A company with profitable ongoing operations. So I'm going to handle this just like I did the UR case. Is considering a major project. The company has completed extensive research and development testing on a new product at a cost of $150,000. So that is completed, sunk cost. And is now considering whether to proceed with production or not. If the company goes ahead with the project, the company will be required to invest $600,000 in new steam and electric generation machinery. So this is our capital spending. This is the investment. There could be many, many of these exercises just have one, but I don't want to make it too messy as you're learning. So that's capital spending, our initial outlay, our initial investment. So I'm just going to put investment on it. I can even just put I can label it with number 2, because that's from dividing up all of the incremental cash flows into 3 parts. That goes in number 2, investment. This equipment belongs to the asset class 00.4 and has a general depreciation schedule of 15 years. So similar electronic machinery would fall in this class. So I pulled this out of the maker's table with 2 decimal places. I gave it to you slightly different than the one I gave you yesterday. So work with this because the clave works with this one. The answer key, the solution set, works with this one. It is expected that the project will generate incremental revenues of $300,000 per year for each of the 5 years of the project. So this is an annuity. This all goes into income, right? So this goes into income and it's an annuity. And then we have the expenses of $50,000 that goes into the annuity for 5 years. So this is a 5-year project. Have you said that previously? Anyway, this is a 5-year project, something else that's important. And these are income. These are part of income. Good morning, everyone. People still coming in. It is anticipated that after 5 years of the project, it is anticipated that after 5 years, the project will end and the equipment will be sold to a competitor for $75,000. That is the salvage. And that goes into number 2, right? Investment. And then the company also anticipates that it will have to maintain its working capital requirements above its regular levels as follows. Okay, so this is the addition to addition to working capital requirements as a result of taking on this project. So we need to determine the cash flows, incremental cash flows from these amounts. So here there's no summing, there's no adding. I give you the final, like in the last exercise that we did yesterday, the UR case, we summed up all the portions of current assets and current liabilities, right? We subtracted current assets by current liabilities. And here, we will just use the numbers as they are, remembering that in the 5th year, there are no, the project closes, the investment is released, that the funds are released to the firm and for its other purposes, other projects, other operations, all its other operations. Okay, so this goes into net working capital investment. So this is part of investment. Number 2. That looks terrible. Okay. Okay, so we've got that. What next? An additional complication of the project is that it is expected to cause a labor shortage. So we discussed this yesterday. This will result in additional overtime costs, estimated to be $20,000 per year for each of the 5 years of the project. So in this case, I reserve this, so this is just overtime. It's not affecting, if they didn't increase the salary or the wage of other employees. All they did was they included extra overtime. Okay, so additional overtime costs. So that will end after the project is over. So I underlined the wrong thing. So this goes into income as well as a cost. The company pays income taxes at 40% and has determined that the discount rate appropriate for the project is 10%. So this is cost of capital. This is going to be our I in our formula. And this is going to be the rate, TC. Okay, got it? So I specify how you're going to split things up. In the test, I'm just going to give you the problem and you have to organize yourself. Okay? You can use this as a guide. Income. To compute the present value of income, find the present value of after-tax net incremental revenue minus expenses and subtract the present value of the after-tax side effects caused by labor shortage. So you have to put all those things we talked about from income in here, and don't forget to take to consider the amounts after tax, right? Because this is a net. You want the net operating cash flows. That will give you that, representing the profit each period. And then you take the net present value. Or we could say the present value. Okay, investments. So sum of the cash flows. Oh, I said A, B, C, D. Okay, well, I guess I collapsed my more detailed explanation. So sum the cash flows to compute the present value of investment. Oh, okay, so I have it here, sorry. The present value, so I do outline it for you very nicely. The present value of the initial investment is negative cash flow, $600,000. At the end of 5 years, the capital purchases at the start of the project will be sold $75,000 for $75,000. Determine the present value of selling this asset by computing any tax savings. So this is the discussion here. C is where you have to determine if there's capital gains or a loss. You have to get the book value. So we've got to do everything pretty much except for adding. For the net working capital investment, we just use the table, the last row, like we already have the final row. All right, so for the solutions, for the solutions. So you really can start wherever you want. You don't have to go in order. As long as you label the sections, I'm happy. Okay, let's say what I did here. Did I miss? All right. So for income, remember you had revenues and expenses. So you can put those together, right? You don't have, so we're not going to make a table in this exercise. We're not going to make a big table. We're only going to use the table for computing the book value and the tax shields, tax savings that result from the depreciation of the machinery. So what we're going to do is just put these together. In an annuity, $300,000 revenue minus $50,000 expenses is a difference of $250,000. So that's what I do here, and I make an annuity. This is annuity for 5 years. Right? This is an annuity for 5 years, and then there's this term, which you should never forget. For income, this is the one students sometimes forget. You take the value, 60% of the value, because 40% you pay in taxes. So this is going to be $250,000 having a heck of a time. I think my stylus is going blunt. It's so messy. I hope you get the point. So that's $250,000. And so put that into your calculator with your keys, right? 5 into n, and then 10 into interest. We're going to use what we've learned so far, and then not PV, we want PV, and then 250,000 into payment, which, well, you could put 250, you could just multiply these already. So 250 times 60%. You following what I'm saying? Because 1 minus 0.4 is 60%. It's 150,000. Oops. So that's going to be what is this piece? No, that's not going to work. Okay, so I'll just fix it as 150,000 into payment. And we don't want the future value, 0 into future value. That's not what we're interested in. And so you get this number. So that's income for the first part. You have to consider, though, the cost, the additional cost for labor. Now I've separated them, but I don't have to, right? I could have put the 20,000 up here as well. But I guess for illustrating this to you, it was useful to separate them. But you could just put the 20,000 as a negative up here. Don't forget the negative, because this is a cost. And Even though sometimes I mentioned you can see this as a perpetuity, with the example, well, what I mentioned yesterday, if you affect all workers' wages that stay indefinitely higher because of the project. In this case, we're just paying them overtime, so they're getting extra when the project's over. Those employees aren't going to get the extra income. Yes, into the exam. Is it 115? I'm not sure where 115 comes from, but in the exam you could put these two together. It's fine. So it would be 300 minus 500 minus 300 minus 50 minus 20, and then after tax, and I guess you get 115, right? That's what you're saying. So if I did 300 minus 50, 250, so it's 230,000 times 0.6. No, I don't get that number at all, but anyway, Chris, I don't know where you're getting 115. So 300 minus 50 minus 20 times 0.6, 138. So if you put it all together, you get 138. If you combine them, okay? Otherwise, you have to do them separately. Is that all right? Okay, so putting all of it together, we have this final result. So income alone is $500,000. I'm confused by Chris's comments. Okay. 300 minus 50 minus 20, so 300 minus, so it's 230, and then 230 times 0.6 gives you 138, not 150. Okay. Let's see. I'll make sure I can get the same answer. So if I put 138 instead, do I get the final answer over here? So 5 into years, 10 into interest, nothing into PV, and then 138,000. And 0 here, and F future value, compute PV, 523, 128. Don't forget about your signs, okay? Okay, I hope you get that. All right, so then I'm moving to investment. So investment includes the initial investment, which I referred to as Part A, so I numbered it for you. And then B and C are both found from the table. This table is derived using the values I gave you as though they were in the maker's table. Oh, I did put more decimals here, so I ended up, I don't know what I did. So I told you to use this, and then I used the maker's table I gave you. I should remove that then. You might have had different answers. Let me check some of these. So these are the values from the original maker's table. I'm pulling it up. So for 15 years, oh, it's not even there. What did I do, my friends? Oh no, these are two decimal places? No, are they? What are these numbers? T 0.05, okay. 0.095, 0.0, okay, no, these are the decimal versions. Okay, no, this is okay. So these are just the numbers from the chart, because otherwise the maker's table doesn't have 15 years. So these are just the decimal versions of the percentages I gave you. Right. And the way we use the table, you should go this way but the way the table works, you could just go straight down, because all I'm going to do is multiply column 1 by 600,000 every time. These values have been determined, so that's all you need to do. Each time, however, you need, and you're calculating the D, the big D, depreciation. And then here, what you're figuring out is what remains. So out of 600,000, you take 30,000, that's 570. Then another 57,000, that leaves 513,000. Subtract another 51,300, you get this. Subtract another 46. So you're just figuring out the undepreciated cost of capital. So that's what's left. All the way to the end where you find the book value. We really need this, and then we're going to discuss what we do with that. The last thing we need from the table, which actually goes in the third part. So this is for part 3, which I guess in the exercise it didn't, well, I mentioned that in the investment piece. Let me go back. Let me go up. So I said part 2, and then so part 3 is the present value of tax shields. This is going to come from your calculation in part 2. Okay, so that's in the table here. So this is part 3. Present value of tax shields, tax savings. Got it? Are you with me? Should I give you some time to punch everything in? So let me give you 3 minutes. Make sure you can get all those numbers, because maybe some people fell behind. So make sure you can get all those numbers and let me know when you got everything on this page, and then we will combine them. This will be part 3, and then part 2 will be this together with the investment, and we have to do net working capital still. So confirm you've got all of this and any questions you have. No one? You guys got it? No comments? You're calculating? Oh my goodness. Okay. Give me 5 people got it, and I will go on. So for people who feel overwhelmed, as long as you're diligent, you divide everything up step by step. Don't think that you need the final answer, okay? You don't need the final answer. It's a process. It's going to take you, it could take you half an hour to do the case. It could take you 3 hours to do the case I give you on Saturday. That's fine. That's just fine. And then go back to these and make sure, you know, you've got all 3 and you're considering all the components. And just be patient. It unravels, okay? The results unravel. Some things to remember. Don't forget, for income, you always have the after-tax amount. And for investment, that you have to make this table. But you're not done. The table is not everything, okay? It's a lot of work, but you're not finished once you have the table. Okay, one more person. No pressure. And I could go through 5 exercises and you won't learn anything. You need to apply it yourself. Okay, I got 5 people. Okay, other people who are still calculating, just hold off. Let me finish this, and I'll take another break later. So let me finish, and then we'll take another break to give you some time. All right, so what we have to figure out is the effect of the salvage. We're going... Hold on, I just got interrupted. Okay, so I got interrupted, sorry. All right, so this is the expression I told you to put on your formula sheet. What we're going to do is put the numbers in until we understand what we're doing. It says put the salvage here and then figure out the difference between, so how much was left? What was the book value after depreciation of the machinery? So the value of the machinery that remained was really $373,920. So we are at a loss when we sell it for $75,000, which we can claim thanks to the IRS. So we are going to put this in the expression to figure out the tax savings that result from that. So that does it automatically for us, okay? So this is the tax savings. Remember, tax savings is always TC times whatever your claimed amount. So this is like whatever you're going to claim times your tax rate, and for us it's the corporate tax rate. So you get that number and then add it to this number, and I get 194. But this happens, all this business happens in the 5th year. So by the end of the 5th year, you get that. because you're going to get the salvage and then you're going to claim the loss on your taxes and realize tax savings, which is a cash flow, a total almost $200,000 that you're going to get out there the 5th year. So you need to discount that. So this gets forgotten sometimes. Just you have to remember the storyline. It makes more sense when you have like the big table like we did for UAir where you saw everything, but that takes more time, I think. You've got to get in the hang of doing it either way. And this one is more efficient for this exercise. So remember, this happens in the 5th year. Okay. The other part of investment, so we've dealt with we know the investment amount, we know the book value to calculate this, and then you can use these steps, for your other exercises as well. This is a nice outline of what to do. And then we need to get the working capital requirements. So from the list of working capital requirements they gave us, I need to remember the 3 steps. So the first step, they gave it to you. The next step is you find the changes. How much more do you need each year? Because the idea of working capital is that you need $50,000 up front and then additional amount by the end of the 1st year. So you have to top it up. Okay, so you have to allocate funds to do so for inventory, cash, remember, accounts payable, all of that. So that extra is $30,000. Then to get to the 2nd year, it levels out. It levels out, so nothing happens. Nothing additional is needed. And then we wrap up the project, release those funds, so that's negative $80,000. That's the difference between the next year and now, or 5 and 4. We have to change, so that's called net working capital changes. Now we have to figure out the investment from this perspective of, so this row is the perspective of the project. The project needs $50,000. It needs an additional $30,000. So these are incremental cash flows, and then it doesn't need $80,000. But from the perspective of the firm, which our analysis is about, we need to change the sign across the board. So this actually looks like an investment from the firm into this project, etc. And this is a release of funds. So this is a positive cash flow from the perspective of the firm. Okay. So this portion I could figure out as mixed cash flows. You can do what you want. I mean, you could just use the Y over the X key if you wanted for this piece. But it's the NPV, right? It's NPV. Just got to put 3 zeros. So you change frequency to 0 for that. Okay, so let's do the last one, and then I'll give you some time to compute everything. Investment is all those pieces. It's the initial outlay, the effect of salvage, so you get the book value and the effect of, let me make sure, yes, yeah, that's the amount for the effect of the salvage, the impact of the salvage, being able to sell it, and then tax savings because of it being sold at a loss, and then the net working capital requirements. Remember, this is a negative. Put it all together and you get that. So let me give you a few minutes. Let me know when you have added it all up. So I'm just waiting. Got it? Somebody? Okay. All right. Step by step. Keep on swimming. So you get to use all these materials on Saturday. They're at your disposal, right? They'll be next to you. Imagine students have to write, in my class, a case without any materials other than their formula sheet. They have to be very organized. So you might take the opportunity also on a sheet of paper to maybe create an outline for yourself. This is a good starting, the only thing about using a different timeline, a different outline, is that you might miss something if you have a kind of different question. But the idea of 1, 2, and 3 is really important, and assigning each incremental cash flow to one of those can help. All right, so looks like several of you got it. Okay, so the result is we put it all together and get again $500,000. So from income, if you look back, income was just over $500,000 as a positive cash flow. Investment is almost $500,000. Well, a little bit over. So they pretty much cancel out, but it is still positive. The real effect is in these tax shields. We're going to get an impact in these tax shields and a difference here. So let's see, what are the tax shields? What do they give us? Taking the amounts in the last column and discounting them. Starting, this is another thing you got to be careful about. The tax shields start after a year, right? There's nothing here because we wait for a year of depreciation. There's no depreciation up front. So a year after, these are the tax shields. Remember, the first one's a little bit, it's because of the half-year rule, you don't get to depreciate as much. Then it goes up and then it starts to fall. So the tax shields result in $68,000 in present value terms and time $0. And then finally we put everything together. Income, investment, which almost canceled, leaving about $20,000, and then the tax savings from depreciation make us give us the net present value of $84,459 and 26 cents. Oh, I am going to be picky about this, so work with your decimals. Try and get your decimals right. The grader was taking off 0.5 point if you got the decimals wrong. So do your best. It's not a lot. It's not a lot of points, but well, this is actually similar to UAIR. The only thing is I answered it with annuities. So for me, they're the same, right? We had an investment, we had a salvage. The only difference really was that we sold at a loss, and that formula extracted for us the amount we were going to be able to claim. So for me, this is just as difficult as you wear, but you can lay it out as you wish. You can do it this way. You can do it with one big table. Some students like the table. I don't like tables, but you could make, everything on a table, year by year by year. But that's up to you. You could repeat this whole exercise on your own and setting it up in 3 different tables that you combine, like I did in the UR case, to see if you get the same answer. All right? So I won't be asking you for the total project cash flows and forcing you to do a table. I won't do that. How about we do another one? What else? Which other one would you like? Just gonna go in order. Review 2. Okay, the second. All right, so yes, the second one of review 2 looks different still. It does look different. You guys did okay with this one here? Identifying the incremental cash flows. The only thing here is the idea that this is an opportunity cost. If toothpaste is produced, 300 machine hours will be taken away from existing product lines. That's really a side effect. But some students interpret it as an opportunity cost. So I was giving them points for this, but this is really a side effect. I'm going to cross out opportunity cost, sorry. It sounds like an opportunity. You're taking away something you already have, but I'll leave it. It's just so. Anyway, so the second exercise. As a newly hired financial manager of the Espresso Roast Corps, you are considering the following investment to produce specialty roasting equipment for the next 4 years. The required investment in machinery is $40,000, so that's my initial outlay. After the 4 years of the project, the machinery will be sold. So this is the salvage value. You see, similar pattern of things. According to makers, the firm can depreciate the investment using 7-year depreciation schedule. So you use the table I gave you. The firm is in the 40% tax bracket. So remember, it's a 4-year project, but you're going to use, because of the type of asset that the machinery is, we use the 7-year depreciation schedule. But we're just taking the first 4 years of percentages of rates, depreciation rates. 40% tax bracket. The price of your product will be $300 per unit and will remain constant for the duration of the project. So this is the price, which will help us determine the revenues. But then there's expenses, and the next sentence is about expenses. There's costs of labor, which are $12 per hour, which will increase at 1% per year. So that's labor costs. Don't forget the 1%. So what does that sound like? For 5 years, labor costs will increase at 1%. Okay, so the only question here, am I going to make that be perpetual, or am I going to see that as 5 years of the project? Or has it affected the labor costs across the board, all of my employees, and it's going to do it indefinitely? We'll have to see. What was my interpretation? Did I give you other information? Let me see. Oh, it's a 4-year project. Yeah, I treated it just like the 5 years of the project. So just for this equipment, okay, so that we bought this, we're buying this new equipment, and we've got to hire employees for it. We're going to say that they're hired at $12 an hour, that there's no labor shortage to deal with. In other words, we're just offering them the rate that we offer the others, but then it increases at 1% per year, given some anticipated labor market effects. Okay, so this is what we anticipate for our employees, but it's just for the 4 years of the project. Energy costs, so now these are the operating costs. Energy costs will be $5.15 per unit. They will increase at 3% per year. So and the units, I keep on saying unit, the units are here. These are the units. So 500 units, 200 units, okay, and then 150. These are the input hours. So we have the rate, the price, but these are the input hours each year. By the end of each year, it's level, and the energy input for the energy costs are here, and I put the price per unit here. So you got to combine all of these, right? So you can make a table, or since the rates, except for the units themselves, the inputs are level. So you could use an annuity here, but this would be mixed cash flows here. Do you want some time to look at that and try to calculate, making a table? This is the table I come up with. So following all the rules, all the information, using all the information outlined, units sold it would be 300 per unit. And there's 100 units. So that's 3,000. $30,000, sorry. And then $300 per unit with 200 units. Yeah, so we're producing this special equipment. We need machinery to make the equipment, and we're going to produce 100 units. 100 times $300 per unit gives us our revenues. Then for costs, we incorporate the effect of the increase of 1% in every year. For energy costs, we can include the 3% increase every year. After multiplying the units times the price per unit. So I made a table. Compute net revenue, and then after-tax net revenue. So that's going to be this one times 1 minus 0.4. So remember, income, you always have to do this with after-tax. Right? Okay, let's see, maybe I have the wrong answers, wrong numbers. So the labor costs. The labor costs are 2,000. Then you have to take the 2,000 and multiply by 12. So it's going to be $2,000 multiply by 12. That's hours, and then $12 per hour. And then it increases by 1%. So then it's going to be 2,000 times 12 times 1.02. Did I say 2? 1%. And then year 3 will be $2,000 times 12 times 1.01 square. try that. And then for the 4th year, it's going to be $2,000 times 1.01 cubed. Right? So you leave. That should give you the answers. Try those. Okay, you got that? So that's how you work with the rates, and you do the same thing for energy. Energy 200 times 515 in the first year. Then 200 times 515 times 1.03. So this is a perfect example. You know, do you like it doing this way? Or do you prefer doing the annuities? Now you'll know your style. And don't stick with your style. I mean, if you have time to do both, to get a feel for what you like to do both. And to check your answer. When I used to be a student, I would always try 2 different ways to get my answer to make sure I had the right answer because I didn't have the answer key. Okay? So this is up to you if you want to use a table. Then mix cash flows to solve for the present value of income. Or, if you see below, I use for the amounts, the units sold are different. The income, the revenue from each is 300,000, and then we have to pay taxes on that. So this is the net revenue, after tax revenue. So that's how you figure that out. And then the expenses together are the labor as an annuity, and I spelled labor the Canadian way. I don't know, do you guys spell labor with a U? I don't even remember now. And then 4 years, and then here it's energy. You add them together and you get this amount for expenses. So it's revenue minus expenses. You get the same result as you do in the table. Okay. Investment. We have to spend $40,000 on this equipment. Is there anything else in terms of investment? In terms of investment, what do we have? We have, okay, we have the salvage here. We have the expense here. And there are no additional networking capital requirements. Somehow the firm has no mention of it. Okay, so apparently they're going to operate using what is already existing. They don't anticipate any increases in networking capital required. So that's it. We have to put together this piece and the salvage. But to get this, to determine the impact of the salvage, we have to make that table where we use the seven-year depreciation schedule for makers. And then from there also we'll get the tax shield. So a lot of information from these two numbers. So we make a table with 40,000 and these amounts from the makers table. I use a 7-year schedule here. Yeah. So these are the numbers for 4 years from the 7-year schedule. So let me give you some time to confirm those numbers for yourself. Just remembering these steps, these headings, okay? See if you can get my numbers and in the end resolve or get the result that I have for book value. So you need that and you need this. Oh, you got it? Getting the hang of this? People who aren't, you pull these values out of the table, just multiply the investment by the D, you get these amounts. You only need this because, which is just 40 minus 5,720 to get this, then minus an additional 9,800 and get this all the way down to here. This is what I want. This is the most important number. So if you make a mistake early on, I have to penalize you, but then I have to consider this is your value for the rest of the calculations. Very hard to grade. So we use our expression here that you're going to put on your formula sheet until you feel confident to do this yourself. And what it says is, in the 4th year, we'll be able to sell the machinery for this amount, but there's an impact possibly if there's a difference between what it's worth on paper in the books versus what I sold it for. So if I sold it, in this case, I'm selling it for less, just a little bit less than its book value. The market value is just a little bit less. So I can claim that loss. As a result of claiming it, remember it's always, the tax savings are always TC times the claim, whatever the amount is that you claim. All right, so let's see. So 12,480 minus 12,000 leaves 480, right? So this is just 480 here. And you get tax savings on that loss. So 0.4 times 480 is 192. That's how I get that. 192, so that's why I get 12,192. And then I discount it because it happens in the 4th year. All right, so I just put the two amounts together and I get the present value of investment. The last step is just take these, discounting these as mixed cash flows to find the tax savings that result from depreciation, separate from the effect or impact of the salvage. And that's this amount. So our investments are 31,000. Our revenues are 43,000, so it's going to end up being a positive NPV project. And I have it here. So I'll give you some time to step through all of that. It's 10:30. Let me give you, let's figure out which one we're going to do next, and then I'll leave you. So people who are just computing all of that, keep going. I'm going to see if we'll just look at the third one now. Okay, so we have here the TTT. Let's do review 3. So these are just capital budgeting exercises. Once you've done a few of them, each one has something slightly different, but if you can do one of them, you can do most of them to 90%. It's just maybe a little twist or something extra each time to keep it interesting, okay? Now I'll give you a 5-minute break, and next up is review 3. Okay, so these are good questions now. You guys are starting to, so you're getting the basic steps. Now you're starting to question things, which is good. So now you're synthesizing. You're asking, Javier is asking, why is the terminal considered at the income, in the income table, and the planes in the investment table? Okay, so yes, this is a very important question. We treat the terminal as an opportunity cost. So that's a cost that goes in incremental costs, and it is in the income table because it offsets revenues. The purchase of planes is treated as an investment, which we are claiming as, but there's no tax effect. Like, we didn't do a 1 minus TC on investment, right? So it's the same thing here. We didn't do, there was no, this is really important. There's no, when I put the 40 here, I did mention it, but now you understand a little bit better, and you're starting to ask questions. So look, I didn't put 1 minus TC here. In the income table, it does after-tax calculation of everything, right? But because I don't deal with it, I don't have a tax treatment, I don't claim it as a cost the regular way, I put it here so that I can deal with the effective tax this way. So the effective tax to me is that I can't claim depreciation. Depreciation is not a cash flow is what I'm saying. But there's a tax effect because I reduce my taxable income that I get tax savings. So this is why we separate, because I don't have to put, I don't put 1 minus TC here. I have to generate this huge table to determine the tax savings result using the depreciation amounts, the percentage, the rates of depreciation per year. So it's more complicated. It's not just a 1 minus TC thing, okay? So that's why I separate them. And how you know, because this is the investment. This is the capital spending. This is the new asset. We already had the terminal. That's not a purchase. Okay, so this is the treatment of new assets because the government, it's really interesting. As I say, if I understood that accounting was so philosophical, I probably would have become an accountant, because I really enjoy philosophy. But I think the idea here is, for economics and philosophy, the idea is, we want people buying things. We want to move the economy. So let's give them a little boost. They're going to buy something. Let's give them credit. Let's give these entrepreneurs or these corporations credit for the wear and tear of their new asset, because we don't want them to be scared of buying assets that have to be maintained and experience wear and tear. So that's the idea there, I think. Again, I'm not an accountant, but that's how I think of it. Or not. I'm not writing a legal tax code, but I think that's the thinking behind it. Okay, good question. More questions? So main thing, conclusion, capital spending goes in part 2 because I don't just do 1 minus TC. 1 minus TC is too simple for this. It's a whole different ball game. I have all those different rates to deal with. Again, I apologize. My Spanish is not so good. I wouldn't be able to explain that in Spanish in a half an hour. So I speak English. But hopefully the students watching this can go over and repeat what I've said. And if you want me to clarify, please don't hesitate. Write me and I can do my best to explain what I've said in another way or more clearly. Okay. I was hoping that these videos would have captions, but the last time I checked, I couldn't get the captions working. I'm not sure why, but I will look at that too, so that might help you follow what I'm saying. Okay. You guys are good with this one? Still computing? Let me know. Okay. Okay, I'm gonna go to review 3. Well, that's the last one. Almost done. Review 3. Looks long. No, it's about the same. So it's a page case. Okay, why don't I give you, how many of you have tried review 3 already? How many have tried it? So how many have you looked at review 3? I'm just thinking if I give you, okay, so why don't you work on this for 15 minutes? I'm gonna give you a 15-minute break so you can get started laying this out. Try not to look at the clave, okay? But only, look at the clave only if you're really not sure of something, but okay. Just read it at first. Lay it out. Okay, I'm gonna give you 15 minutes. Let's say we come back in 15 minutes. So it'll be almost 10:45. Sorry, what am I saying? It'll be almost 11. Okay, so check back in 15 minutes. So have a look at that, read it through, and then we'll do it. This is the last one. So then I can look at the solutions to the other topic, techniques for valuation, when we come back. Well, after this, if this doesn't take too long. All right, I'm back. I am back. Mm. I can't seem to get rid of that. Okay. How'd it go? Jorge Munoz, owner of Trujillo Pan American Technology, so TTT, is pursuing a special project related to the use of cable television technology for internet access. TTT has already invested $1 million into research and development, so this doesn't count because this is sunk cost, so we can wipe that out. With design and production of a new black box for use in conjunction with existing television sets, and is now considered a leader in the field. The project advantages are expected to last 4 years. Okay, so it's a 4-year project so far. To put this project into full-scale productions, TTT will have to invest $3 million in production equipment, but expects to be able to sell it. So we have investment, initial outlay. Remember that goes to part 2. And then salvage, these are both part 2. This new machinery could be depreciated on a 5-year schedule according to the maker's table. And I rounded to 2 decimal places so that, yeah, because my clave was with 2 decimal places, so follow that detail. Alternatively, TTT could lease the equipment for $50,000 per month. So this is opportunity cost. So this is the alternative, which goes into income. At the beginning, So this is number 1. The safety deposit, they would also have to pay a $100,000 safety deposit immediately. The safety deposit would be reimbursed when the equipment is returned undamaged. Sorry. I said this wrong. This is not opportunity cost. This is the other option. So these are 2 options. So either we purchase or we lease. Okay? There's a chapter on leasing in the textbook as well if you want some more background about leasing. So this is a lease. So they have to pay $50,000 per month at the beginning of every month, and then a $100,000 safety deposit. upfront. The safe deposit would be reimbursed when the equipment is returned. So you have to consider this as a cost, and then in the 5th year or 4th year, the money comes back. Okay, the deposit comes back. So you have to put that into your revenues. So one advantage of leasing is that the lease payments would be tax deductible. The company expects to receive pre-tax revenues. So those are all about, so that's investment, but this would come into income. This would be the expenditure and these would be the revenues. So these are two different alternatives. Revenues would be $2 million per year for each of the 4 years of the project, and you assume their end of year cash flows. The firm has also estimated that additional expenses of $500,000 per year for each of the 4 years will be incurred. If the company proceeds with the project, working capital requirements related to the project will have to be increased. The projected net working capital requirements are these. So this is the first step of the net working capital table. Additional costs are the labor costs of $150,000. So I just give you a lump sum amount indefinitely. So every year, at the end of the year, you're going to account for $150,000 cost. And you're going to do this outside of the 4 years of the project. This is going to be forever. So we expect there's a labor shortage. We have to attract employment to our firm. In so doing, to do that, we have to incentivize by increasing our wage. We have to offer more, and that affects all the other operations of the firm, and this will go indefinitely. We estimate that it'll be $150,000 a year. Assume all cash flows. Oh, I don't know if you can see this, so let's put this up. Assume all cash flows occur at the end of the year. Even if I didn't write that, you would assume that. The firm's corporate tax rate is 40%. The appropriate risk-adjusted rate of return is 15%. Should this company lease or buy the equipment? Answer each of the following questions in order to help you compute the impact of the NPV of the project of the two options, and then state your recommendation to lease or buy and the reason why. Okay, so we separated two exercises, two problems in one. I actually gave you some, we go by steps here. Okay, so I help you, I give you an outline. Evaluate the impact on the NPV of the project if the equipment is purchased and resold. Include the effect of the purchase price, tax shields, and salvage value of the equipment. So now this is kind of out of order. You have to just follow the instructions. The idea is, let's start answering, let's look at what's the impact of purchasing equipment. So we have to buy, we're going to buy it, and then the tax treatment will be captured in this table using two digits, decimal places. I find the depreciation amounts that I can claim. Then subtracting 3 million minus 600,000 leaves 2,400,000. Minus the depreciation the next year leaves a little less, and so on, to get in the end of 4 years to a book value of 510,000. I can also calculate the tax shields. This is the cost savings from depreciation, which I compute using the tax rate, right? So whatever I claim times the rate gives me the cost savings or the tax savings, the savings. tax shields. All right. So the question was to just put all this together in present value terms for purchasing the equipment. So the tax shield portion is here. The effective salvage is here with the formula that I taught you. Salvage plus the difference between the book value and the salvage. So you're selling at a loss of $10,000. And so you get to claim that, and that'll result in tax savings. That all of this occurs in the 4th year, so this is the total amount as an effect of the impact of salvage, of selling the equipment. So the net present value of buying is the $3 million cost, the tax shield, tax savings, positive cash flow, and then the money back from the sale at the end in time $0. So the investment is going to be about $2 million. You see, we've offset it, the $3 million, with these amounts. Okay, so that's how that figures in. So in this exercise, I'm going to assume everything else is the same. All I want to see is the impact on buying or leasing. So that's the impact of buying. What about leasing? So if it's less than this cost or this investment amount, I should go for leasing. So let's put that together. Leasing involves the cost of the lease, and payments are at the beginning of the period, right? So we have to use an annuity due formula for that. Then the money that we get from, we have to pay money up front, the safety deposit, which we get back when we return the equipment undamaged or satisfactorily not damaged, because there's going to be some wear and tear, which the leasing company can also depreciate, but that's not for me to analyze. All right, so here is the safety deposit. There's two impacts. First, you have to pay it, and then you get the money back. But because it's 4 years from now, it's not exactly $100,000 you're getting back. From the time, so from the perspective of today, it's $25,000 that it's going to cost me after taxes. Don't forget this piece. So remembering, in handling this problem, I noticed I treated all this information in part 2. This is like part 2, investment, because I bought something, a fixed asset. And so that gets managed differently than if I lease. If I lease, it goes into the first, it goes into income. Going into income, then I'm calculating net operating cash flows. I have to compute my amounts after tax. Why? Because the safety deposit is a cost which I can deduct from taxes, right? The firm can use this, and in the end, this is just what they end up paying. So the tax effect, and then getting the money back, even though it's in 4 years, $100,000 safety deposit from the perspective of today is really just $26,000 cost. So why did I do the tax shielding? Oh yeah, I guess because I have to, let me go back to, you're right, I added that because it said, evaluate the impact of the project if the equipment is purchased and resold. So it says, the effect of purchase price tax shields. I put it there, so I should write that down. That's why I put it there, because I asked for it. So I'm going to put that here too. So also 3. So 2 and 3 go into purchasing the equipment. So that's really a refined understanding of what's going on. If I purchase an asset, it doesn't enter as a cost. I expense it. In other words, I use the IRS schedules so that I can expense the cost to me in terms of depreciation over time. I don't put it in as a cost like I would income in the income section. It's very, very important. Yeah, it's the same thing, Javier. Since the 10,000, 100,000, I guess, result of the sale of the equipment. Oh, sorry, you're looking at the sale of the equipment up here. Sorry. So you said since the $10,000 result of the sale of the equipment at year 4 is a gain, shouldn't we multiply it? Didn't I do that? Did I miss something? Yeah, that's here, Javier. That's here. Does that part. So that's the that's you're jumping ahead, which is great, but yeah, it's here. I made the calculation and put it here. Oops. I put it here. Okay. It's not a capital gain, it's a loss. Because the book value, it's book value minus salvage. Did I do it the wrong way around? Right. It's book value minus salvage. So it's not a capital gain, it's a loss. And that's why it comes in as a tax savings. Remember, look back, this is the formula, book minus market value, or book minus salvage. It's a plus because we have a loss, which we can claim in taxes and get tax savings as a result. That's this calculation here. Yes, it's a loss. Very good. Okay. So back to what we were doing. So if we leased, it would be handled in income, and we would have, all right, the safety deposit I dealt with. Okay, so then the lease situation. The lease is treated as an annuity due. An annuity due up front, 50,000. At this rate, it's monthly paid, so I need the monthly rate. You don't get to forget anything. You have to remember all these parts. And it's going to be 48, so it's 12 months. for 4 years, so it's 48. So for the formula, I had put 1 less here, remember? And this is a cost, so this is going to be, we want the after-tax amount. So this is the cost of leasing, additional with the safety deposit, makes $1,135,000. The cost of leasing, the net present value, or the present value so which one is cheaper? So we're going to assume, because we have no other information, that revenues, expenses, net working capital, investment, cash flows, they'll all be the same. So I don't have to look at those because those are all the same. What I just need to compare the thing that's going to be different, and that's going to be the effect of how I purchase the equipment. So all you do is compare them. Since the cost of buying is higher, the cheaper one is recommended. So I recommend leasing. And that's that. So this was maybe, like I said, the questions are all similar with a twist. So this has a lot less things to do. All you got to check is one thing and compare it, assuming all the other elements of a capital budgeting problem would be the same. Notice the utility, the usefulness of working with annuities rather than making the entire table for both cases with a project, like the total project cash flows of both options. You don't need to do all that. All you had to do was, all you had to do was identify what's distinct or different and analyze that piece. And it was pretty much efficiently done with annuity formulas and NPV. So I am done looking at this. Do you have any questions? Do you want more exercises? Today's Wednesday. I'm supposed to post the Connect today. And to be due on Sunday or maybe Monday. I'll let the Connect be due on Monday. Well, Monica asks if there are leasing problems, is everything else always the same? And we only need to do this for the process? Not necessarily, but I could be doing other things. But if I was just focusing on the lease or buy question, yes. This is how you would approach it. Okay, you would use all the techniques of that you've learned to evaluate investment, the investment portion for buying and the income portion for leasing, and compare them. But if it was just two completely different projects, you would have to compare, you have to look at all the elements, right? Yeah, I'll make the Connect due on Monday. Remembering Monday and Tuesday, I'm not going to give a lecture, but I'll give you some things to do. So what we need to do is for Thursday and Friday, we're going to start the new material. And I'm going to leave you with things to do next week until we meet again on Wednesday. Okay, so should I give you more of this? No, because we're going to get into the new stuff now. If you want another case, let me know. If you just want to focus on learning these, that's great. Maybe I'll give you a case without the answers and then give you the answers on Friday. We could do that. That would be useful because that would be different. Like I give you one case and you can work on it together for the rest of the week. So it'll just be a homework without the answers. No comments? Did I ask too many questions? So the question is, yeah, Laura, I'll give the Connect to be due Monday night. Sunday is Father's Day. So yeah, and you need a break after the test on Saturday, right? So let's do that. I'll give you another case without the answers. We'll distribute the answers Friday night. So you have something to review in addition to what you've already done. The test on Saturday will be techniques and this capital budgeting. But as for now, for Thursday, Friday, I'm going to focus on risk and return. We're going to talk about WACC, which you should know. Does anybody not know what WACC is? Just going to give me an idea of how fast I have to go for WACC. So see who does not know what WACC is. No, I'm not. I'm just going to give you a case, Carola, nothing about valuation. I gave you enough exercise for the valuation problems you can practice. So you all know what WACC is? So we're going to have some fun with WACC this week. And then next week, we will do some dividend policy. And what else is the big thing? Well, we have some stuff to do with the investments that you need to learn. Okay, so I'm assuming you all know WACC. What chapters of the book? So what we've done, so if you look at the syllabus, I wrote down the chapters of the book. So let's see. So the chapters of the book for the test would be 5 and 6. I guess just chapters 5 and 6, and maybe did I write down the leasing? Maybe 5 and 6 and 25 and 29, but I never read those chapters. I would have to verify if that would be in it. Yeah. But you're asking me about the Connect too, right? So yeah, the Connect's going to be on 5 and 6, and I'll probably put some things from 7 and 8 in Connect because I'm going to cover Connect. I'm going to cover chapter 7 and 8, risk and return and cost of capital, 7, 8, 9. So let me write that down. Okay. I'm going to give you a lot of reading for next week. But for now, yes, Carola. So, Brenda, you don't know what WACC is? Okay. So, like everything we've done so far, it's kind of a review, but then I go deeper. Do you agree? It sounds familiar. You've done it before, but I'm going much deeper and refining your understanding. So we're going to do the same thing in approaching WACC. I'm going to do that tomorrow and the next day. And then we're going to use it. So let me write this down for the test. So for the test, it's going to be chapter 5 and 6. Remember, always focus on my notes, right? And then this is just reference. The textbook is mostly reference. It gives you a deeper background context for what we're doing. Okay, so the test would be chapters 5 and 6. Projection of cash flows and techniques for valuation of alternative investment projects. There's kind of an overlap with 7 and 8. But okay. The point is it's projection of cash flows. This is what we've been doing. Connect will be chapters 5, 6, 7, 8, 9. It's a lot, right? I mean, I'm saying that, but it's all going to depend on, so I'll say that. Well, so we're going to try and get through all that in the next 2 days. 6 hours. What else did I say? If you want to read about planning, financial planning and leasing, I need to check out if that's a good reference. Let me see. I'm just checking the book. There's so much more information in here that it's gonna... So you can read chapter 25 on leasing. That's not exactly what we're doing, so I'll just say read. You can read chapter 25. So for reference, but I won't put it on the connect or the test or anything. Tomorrow and Friday's class is new material, right? Not coming on the exam, right? For Monday night will be connect, right? And you will send us another case. No, I'm gonna send the case now, and then I'll give you the answers on Friday. So you actually have a case to struggle with, because that's what you're gonna have on the test. So I will give you a case to struggle with for extra practice. Did you get that? So test, connect, due Monday at 9 p.m. Case without answers, 2-day solutions given on Friday. All right, so Friday night you'll get the solutions and you get to see your mistakes. So new material, which is really kind of old material, but we're going to work with CAPM and then some other techniques about investments. I need to review statistics. How are you guys with statistics? Who in the chat would like a statistics review? And I mean, I can do it in like 2 hours, but it's 2 hours. Who wants a stats review? Because maybe what I can do is save time, I can just make a video that you guys watch. I have to teach you how to use your calculator for statistics too, right? Okay, if you guys are good, I'm not gonna do it. If some people would like a review, just let me know, see how many people there are. If it's just a few people who need a review, then I mean, I won't spend time in class on it. And I'll just make some other video you guys can watch. Okay, review, keep writing, let me know you need a review. I tell you, most students need a review, so don't feel shy. I just need to know the urgency of it. I can share anyway review material with everybody, and the people who want the extra review, maybe we'll set aside a time that we can do that. I don't know. I'll think about it. That's it? That needs a review? So you guys have no questions from the techniques? No questions from from Monday's material? Should I do that? Should we look a little bit, because it's still a little early. We can spend 10 minutes and look at some of the results. I've given you a lot of stuff, but you guys are amazing, and I'm very impressed with what you can handle. You're just doing amazing. I'm looking at techniques. Let's see. 3.7, 3.6, no, 3.5. Okay, so you guys like a review? So my background is, my first degree was statistics. I have a statistics degree as my bachelor, honors degree, and I intended to do a master's, but I changed my mind and studied economics instead. Then I got my doctorate in economics in Canada, and when I started teaching finance, because with statistics and economics, like good statistics or strong statistics and economics, you can pretty much do finance. Finance, though, is its own specialization, so you do need to take time and invest time to learn these techniques and these theories and apply them. And so that's my background, just to let you know. So I really like teaching statistics because I realize that somehow it's not been taught properly, or students don't retain it. I'm doing my best to change that. I have a lot of statistics videos online. I teach statistics in the MBA program, and then I teach research classes. I was to the doctoral students, and right now I'm the director of the finance department, so I'm not doing that much in the graduate school. Well, actually, what am I saying? I'm teaching another master's class too. In the graduate school, I'm teaching economics. But in terms of research, I'm just doing my own research. Okay, so just letting you know that I like teaching statistics, so I don't mind giving a refresher and watching students have those aha moments. Well, I'm not going to be able to watch you have it, but I think you'll appreciate a review, so that's why I'm offering. I really like this exercise techniques. Did you guys follow what happened here and the way that I wrote things? Did you have a chance to look at this? So I'm going to look at this is 3 point, I don't even remember now. Techniques for Evaluation 2. Let's just look at this and then we'll go. I really like this exercise. You should not look at the answers. You should try and do this yourself because there's lots to learn here. Here you have projected cash flows for Organics Inc. So now that we've done capital budgeting, you appreciate where these numbers come from, right? There's a lot of estimation that goes into creating these numbers. And we've done it for Project A and for Project B. So I ask you to calculate the internal rate of return for Project A and calculate the internal rate of return for Project B, and from there determine which project you should take. Now notice, Project A is a regular investment type project, and Project B is a finance project. Remember, first cash flow is negative and only one sign change, the rest are positive. For the finance project, it's an upfront amount received and then disbursement of funds that are all negative cash flows. So because they're different kinds of projects, one's an investment and one is financed, we apply the rules, we apply their individual rules. If you figure out the internal rate of return for Project A, you get 7.6347. What do I do with that number? What I do with that number is I compare it to the required rate of return specified as 10%. So what we're going to do for the next couple of days is actually we're going to focus on computing R. That's what's going to become the focus of the class. So I'm going to just give you cash flows, but we're going to focus on that. You should be able to answer questions where you do both. Determine the projection of cash flows with the 3 components that we've been reviewing in capital budgeting, and then computing the R, estimating the R. It's huge what you're learning. You're learning quite a bit, but getting R is learning a number of theories, and you're familiar with some of them. So that's what we're going to do. So anyway, I've given you R as 10 required rate of return. At that rate, for an investment type project, this is not high enough. This is not high enough of return, so we do not accept Project A. Right? In terms of B, is a finance type project. So once we get the IRR, even though it's 0, we don't interpret it as a rate of return type of thing. We interpret it as the borrowing rate of the project because we took money up front. So since it's a borrowing rate, that's the lowest you can go at 0%. Well, actually, you can get negative rates. We've seen negative rates lately, but it wouldn't be for a commercial project, even though we've seen negative rates between banks. This is acceptable because we interpret this as the borrowing rate which we want to be low, and that is much lower than 10%, so we accept Project B as a financing type project. Okay, so that's Usually students get that wrong when I give that as a quiz or on a test. So be alert, evaluate, assess. Always when you get projected cash flow, assess what kind of project you're looking at. It's just one sign change, so there's just one. If you're going to use IRR, if you're in fear at all, just use the NPV and that will give you the right answer. But when you use IRR, you have to remember there are distinct rules for investment and financing project. So if I did it with the NPV, it would have told me right away the NPV would be negative of the first project, do not accept the project, and NPV of project B would be positive, so you would accept the project. And finally, I say, what would you do if you analyzed them as mutually exclusive projects? Well, the way that I analyze the first part, remember, I distinguish between independent projects and mutually exclusive. Independent means you just look at the project cash flows and determine on their own merit, should we pursue the project? And that's what we did. But what if I combine them? I can only pick one. Well, here it's the same answer. I'm still going to say just pick B because this one's not even profitable. So pick B. But I just wanted you to carry out the steps of analyzing the incremental project. So you would analyze the incremental project. And I chose A minus B to make sure I had a negative here because, as I said to you, I like to have a negative and then positives because it's more intuitive to me to set it up as an investment type project. So what this means, A over B means or A minus B means doing this, you don't look here anymore. These are done. What you're evaluating is picking A instead of B. That's what you're evaluating, picking A instead of B. And so if it's if A is the one you pick, then NPV should have been positive. If you don't pick A over B, that means you pick B over A. So that's what we do. We analyze these projects, this incremental project, and we find a negative in A over B so that we do not accept A over B, we accept B over A. And then I show you, if I did it with the IRR, it would say the same thing. So it doesn't matter if I take A minus B or B minus A, I should have the same answer as long as I interpret things consistently. All right. With that, I'm going to end off. I'm going to say goodbye and prepare your Connect work and send you a case. So in the meantime, wow, do you have nothing to do? I hope you still have something to do. I'll be in touch. So have a good day. Bye.